Most traders believe mastering chart patterns is the holy grail of profitable trading. Here's the brutal truth that will flip everything you think you know. The traders who can identify the most patterns often lose the most money. Pattern expertise creates pattern addiction, and pattern addiction destroys accounts faster than ignorance ever could. If that stings, good. Pain is data. Meet the two identities battling on your screen right now. The pattern chaser is a gambler disguised as an analyst. He sees setups everywhere, enters early because the textbook says so, moves stops when pressure builds, and calls it conviction. Every pullback screams flag. Every consolidation whispers breakout. Every dip promises reversal. His brain has become a pattern-generating machine, projecting familiar formations onto random price movement. He trades his emotions through chart patterns, sizing up when excited, cutting profit short when fearful. The pattern operator is different. She knows the same patterns, but applies systematic filters before risking capital. Context matters more than formations. She waits for confluence, defines risk before clicking, and treats every pattern as a hypothesis that must pass tests. She passes on dozens of mediocre setups to capture the few that align with trend, structure, and probability. One worships the picture. The other manages the risk. Same chart. Opposite futures. By the end of this series, you'll transform your pattern knowledge from a trigger into a filter. You'll stop trying to be right and start aiming to survive. You'll master the operator's rule. Context over patterns. Confluence over conviction. Process over profit. The stakes couldn't be higher. Continue chasing patterns and watch your account bleed while your confidence crumbles. Every failed trade becomes evidence you need better patterns, more formations, that secret indicator that finally cracks the code. This path leads to blown accounts and broken dreams. Or choose the operator's path. Learn to read the market's true intentions behind the patterns. Master strategic inaction, where passing on marginal trades becomes as profitable as taking perfect ones. Here's a 2-minute story that changes everything. Two traders spot the same textbook bull flag. The chaser jumps in on the second green candle, stops somewhere below because flags break up, right? The operator waits. She asks, what's the higher time frame trend? Where's the nearest supply zone? Is volume expanding on pushes and contracting on pulls? What's my exact invalidation level? Her flag sits under yesterday's high with declining volume. That's a pass. 30 minutes later, the flag fails. The chaser gets stopped out. Then revenge trades back in. -4 our day. The operator. Flat, patient, unfazed. She didn't win. She avoided losing. That's professional. Why does the chaser keep doing this? Because your brain rewards pattern recognition with dopamine hits, the same intermittent reinforcement schedule that makes slot machines addictive. Every sloppy pattern that occasionally works cements the habit deeper. You feel smart. Size up. Then variance destroys you. The market is a mirror, not a casino. If you bring neediness, it reflects chaos. If you bring rules, it reflects edge. Stop worshiping pictures. Start interrogating them. Treat every pattern as a question. Under what conditions does this setup have positive expectancy? A sniper doesn't fire because the target looks good. A sniper fires when wind, distance, and timing align perfectly. One clean shot beats a magazine of hope. I've watched thousands of traders blow up accounts despite memorizing dozens of formations, while others profit consistently with just 3 patterns and iron discipline. The difference isn't knowledge. It's systematic application that treats patterns as starting points for analysis, not ending points for decisions. What if your pattern expertise has become your greatest weakness, creating false confidence in setups that look perfect but lack real edge? There's a simple 10-second test to know whether you're reading a pattern or inventing one, plus the neuroscience behind why your brain sees setups everywhere. Ready to discover what your biology is doing to your P&L and how to rewire these triggers? Next, we crack open your skull and examine the pattern addiction machine inside. Your brain is hardwired to find patterns, and that's exactly why trading feels so intoxicating and so dangerous. For thousands of years, our ancestors' survival depended on spotting the faint outline of a predator in the tall grass or the subtle change in the seasons. This ancient wiring, once a lifesaver, now becomes a saboteur when you sit down in front of a price chart. That urge to click buy when you spot what looks like a textbook setup isn't simply impatience or lack of discipline. It's your biology working overtime. Every time you recognize a chart pattern, your brain releases dopamine, the same neurotransmitter that lights up when a gambler hits the jackpot on a slot machine. The market's constant ebb and flow creates what neuroscientists call intermittent reinforcement. You don't get a reward every time you see a pattern, but when you do, it feels unpredictable and exciting. The most addictive reward schedule known to psychology. You spot a sloppy breakout that pays off, and your brain etches the connection. See shape, feel hope, take shot. The next 3 failures don't erase that memory. Your nervous system gives more weight to the occasional surprise win. This is why, even after a string of losses, the temptation to just try one more never quite fades. But it goes deeper. Your brain isn't just searching for patterns, it's inventing them. This phenomenon, called pareidolia, is what makes you see animal shapes in clouds or faces in the grain of wood. Try it. Stare at the sky for a moment and notice how quickly your mind fills the blanks, turning formless chaos into something familiar. Now imagine that same mechanism firing when you're watching price action tick by tick. Each new candle is a blank canvas. Your brain is desperate to impose order, to find meaning, to feel in control. Here's where confirmation bias makes things even trickier. Once you decide you've spotted a bullish flag or a reversal pattern, your mind immediately starts filtering for evidence that supports your initial impression. You draw lines to fit the story, ignore the inconvenient volume spike, and scroll past the higher time frame that contradicts you. You're not analyzing the market anymore. You're defending your own narrative. The illusion of control grows stronger. If you can name it, you think you can manage it. But the market doesn't obey labels. It moves on liquidity, incentives, and collective psychology. Now factor in the emotional overlay. After a painful loss, fear primes your brain to see every rally as a potential bull trap. After a string of wins, greed transforms every minor dip into a can't-miss buy-the-dip opportunity. This is emotional pattern projection. Your feelings don't just influence your trades. They reshape what you actually perceive on the chart. The monitor becomes a mirror, reflecting your internal state right back at you as supposed signal. No wonder 2 traders can look at the same chart and see opposite trades. They aren't seeing the market. They're seeing their own minds at work. So, what separates the pattern chaser from the pattern operator? It's not intelligence or knowledge. It's self-awareness and process. Professional operators know their brains are built for pattern addiction, not market analysis. They insert a crucial pause, a diagnostic moment between seeing and acting. Before every trade, they ask, what am I feeling right now? Does the higher time frame or context actually support this setup? Where is my precise invalidation? If those answers are vague, they assume projection and stand down. If they're crystal clear, only then do they proceed, but always with defined risk and a checklist, not a hunch. Operators also use environmental controls to break the dopamine loop. They hide their P&L during decision-making, limit the number of symbols they watch to reduce noise, and enforce wait timers. No impulsive entries right after news or a fresh breakout. These tiny frictions give the rational part of the brain the prefrontal cortex, time to intervene before emotion takes the wheel. One practical exercise brings this home. Open a random chart, or one you never trade, and start labeling every pattern you think you see. Notice how endless it feels. Then ask, how many of these patterns have context, supporting volume, and clear risk? Most disappear. This is the difference between seeing, automatic, emotional, and reading, systematic, conditional. The key to breaking free from pattern addiction isn't fighting your biology. It's routing it through a robust protocol. Retrain your dopamine system to celebrate patience and clean passes as much as wins. Every setup you filter out is a victory for your operator mindset. This is the first step toward transforming your trading from a casino experience into a professional operation. But how does this shift actually play out in real trading results? Next, we'll see the mathematical proof and a story of two traders facing the same chart with opposite outcomes. That reveals why process, not pattern spotting, is the true edge. The bell rings. Same chart, same morning, two traders, two futures. A textbook bull flag forms after the open on a popular momentum stock. Clean pullback, tight consolidation, picture-perfect structure. Here's where biology becomes your balance sheet and process separates profit from pain. Trader A, our pattern chaser, feels that familiar dopamine surge. His internal dialogue races. This is it. The setup I've been waiting for. Flags break up 70% of the time. Without checking higher time frames, he sizes up to 3% of his account because he's confident. He clicks buy on the second green candle, placing his stop somewhere below the base. The textbook says flags go up, so he goes all in on the textbook. The market has other plans. Price pops briefly, hesitates directly into yesterday's high, then snaps back hard. He moves his stop lower to give it room, then watches it get clipped anyway. Down 1.2 R. But here's where psychology becomes pathology. His brain screams to make it back fast. He doubles his position size, convinced this reversal is just weak hands getting shaken out. Another fake push, another failure. Now minus 2.7 R. Lunch hour chop arrives, but he can't sit still. A breakout alert dings on another stock. He chases it late and flips short when it fails. By market close, minus 4R, confidence shattered. Charts now look hostile. Trader B, our pattern operator, sees the identical flag and asks different questions. What's the daily context? Price sits directly under a weekly supply zone and yesterday's high. Institutional sellers likely waiting. Volume confirmation? It's contracting on pushes, expanding on dips. Classic distribution texture, not accumulation. Risk-reward ratio. Entry at the break would require a stop below the base, offering barely 1.1 into that resistance shelf. Market structure check. Higher time frames show lower highs and weakening momentum. Her systematic filters flash red across the board. She writes, pass HTF supply, plus poor RR plus volume mismatch in her journal and waits. No FOMO, no second guessing, just data. 30 minutes later, the flag fails exactly where her analysis predicted. No thrill, no pain, just confirmation that process works. An hour after that, a cleaner opportunity emerges. A pullback to prior support with buyers stepping in, offering 1.3 risk reward with tight invalidation. She takes one. Measured shot, partials at structure, closes at plus 1.6 R, and shuts down her platform. One trader waited for alignment, the other chased pictures. Same pattern, opposite outcomes. The mathematics tell the brutal truth. Using the expectancy formula, E, win rate x average, S, win, loss rate x average loss, ET, win rate x average win, loss rate x average loss. Trader A boasts a seductive 65% win rate because he takes every pretty pattern, but he cuts winners early from fear, and lets losers run from hope. His numbers: win rate 0.65, average win 0.8 R, loss rate 0.35, average loss 1.5 R. His expectancy 0.65, 0.8, 0.35, 1.5, and 0.52, 0.5 and fee, 0.5 R, 0.65, 0.8, 0.35, 1.5, 0.52, p 0. 0.5 R, negative edge, dressed in green statistics. He loses money over time despite being right most of the time. Trader B's record looks humbler, but hides the real edge. Win rate 0.45, average win 2.2 R, loss rate 0.55, average loss 1 R. Her expectancy 0.45, 2.2, 0.55, 10, 45, 2.2, 0.50 EBL 1 Delro, 0.999, Mal 4.44 R, smaller win rate, bigger account. That's process beating pattern spotting, discipline destroying hope-based trading. Enter variance clustering, the invisible current that drowns accounts. Misread patterns don't fail randomly. They cluster around emotional states and market regimes. When choppy conditions arrive, or when you're trading from fear or greed, failures string together like dominoes. The chaser's edge relies on fragile momentum breakouts. When market character shifts to range-bound or distribution phases, his setups fail in bunches. 3 quick losses spike cortisol, shrink time horizons, and invite revenge trades. The spiral compounds. Position size goes up, selectivity goes down, losses expand exponentially. The operator builds defenses against clustering. By filtering for confluence and maintaining fixed invalidation levels, she converts losing streaks into small contained scratches. She has pre-committed rules. After 2 consecutive losses, stand down for 30 minutes. No breakouts into daily resistance. No position adds unless risk remains constant. Variance still bites, but it doesn't maul. Notice the identity contrast. The chaser asks, does it look like the textbook? Can I catch it before others? How fast can I recover this loss? The operator asks, where am I definitively wrong? What does higher time frame structure suggest? Do volume and price action agree? Is this risk-reward worth my finite trading capital? From this mathematical proof emerge 3 principles that must live on your screen: confluence over conviction, context over patterns, process over profits. Confluence means independent agreement from multiple factors, not just a gut feeling. Context is your map. Patterns are merely street signs pointing in various directions. Process compounds over time. Profits follow naturally when process is sound. Your job now is operationalizing these principles so there's zero debate mid-trade. No more hoping, no more gambling on pictures, no more emotional position sizing. Enter the sniper protocol, your complete translation system from subjective pattern spotting to objective market analysis. What exactly are the filters, the mirror checks, the if-then triggers that transform you from trader A into trader B? Next, we crack open the systematic framework that makes this transformation automatic and permanent. The math proved the gap between chasers and operators, but proof without process is just painful awareness. You need a bridge from pattern spotting to systematic edge, from reactive gambling to professional risk management. Enter the sniper protocol, not another checklist you'll abandon under pressure, but a complete rewiring of how you approach every chart, every setup, every decision that touches your capital. Sniper transforms you from someone who sees patterns into someone who interrogates them. Each letter represents a decision gate that must unlock cleanly before the next one opens. No shortcuts, no exceptions, no emotional override codes when your account is bleeding and you need to make it back fast. Setup identification forces precision over projection. Stop saying, looks like a flag, and start defining ascending triangle with 3 touches of resistance at 47.82, support rising from 46.15, invalidated below 46.00. When you can't draw exact lines and state clear boundaries, you're creating patterns, not reading them. This precision kills the dopamine rush that comes from vague pattern recognition and forces your analytical brain online. Narrative analysis asks what story the market is telling through trend and structure. Patterns describe shape. Context reveals intention. Is this a continuation setup riding with institutional flow, or a counter-trend gamble swimming upstream against professional money? Check daily, weekly, even monthly timeframes. Your job is reading the current, not fighting it. Patterns aligned with higher timeframe narrative have wind at their backs. Patterns fighting the bigger story face headwinds from deeper pockets. Invalidation level demands you know exactly where you're definitively wrong before risking a single dollar. Not somewhere around here or I'll give it room. Precise. Before you click buy, you must know the exact price where the market proves your thesis incorrect. This level gets honored without negotiation, emotion, or hope-based extensions. The market doesn't negotiate. It only respects predefined risk. Position sizing operates on risk per trade, not pattern confidence. Whether you're absolutely sure or pretty confident, risk stays constant, typically 1 to 2% of total capital per trade. Pattern chasers size up when excited and size down when scared, guaranteeing they risk the most when wrong and least when right. Operators risk the same amount, whether trading their favorite setup or their least favorite, because certainty is an illusion and survival is everything. Execution rules establish if-then triggers that eliminate mid-flight changes. If price breaks the level with volume confirmation, then enter with predefined size. If it reaches first target, then take partial profits. If it hits invalidation, then exit completely. No moving stops, no adding to losers, no let me see what happens exceptions. Your rules were crafted in calm moments. Trust them over emotional impulses during market heat. Review and refinement requires systematic journaling of every decision. Screenshot entries, exits, context, and emotional state. Tag mistakes. Early entry, moved stop, ignored higher time frame, traded into news. This isn't punishment. It's data collection for continuous improvement. Ask nightly, did I follow Sniper? What did the market try to teach me? Which rule needs tightening? 2 anchor tools make this protocol bulletproof. The mirror check asks one diagnostic question before every entry. Am I reading this pattern or creating it? If you feel excited, urgent, or certain, assume creation until proven otherwise. Excitement is a red flag, not a green light. Pause. Check higher time frames. Verify context. Ensure you're not projecting hope onto noise. The confluence filter demands 3 independent confirmations before any entry. Pattern structure plus trend alignment plus volume confirmation. Or support level plus momentum divergence plus risk-reward ratio. 3 separate factors must agree. 2 isn't enough, and 1 is gambling. This filter alone eliminates 70% of losing trades while preserving the 20% that actually work. Your edge isn't finding more patterns. Every retail trader spots triangles and flags. Your edge is filtering them ruthlessly, passing on the marginal to capture the exceptional. The operator's triad becomes your identity. Discipline beats prediction because markets are probabilistic. Patience beats PB'd because quality setups are rare, and process beats profit-seeking. Because sustainable edging comes from systematic execution, not lucky guesses. But which specific confluence factors separate high-probability setups from pretty pictures? What are the 5 non-negotiable filters that transform mediocre patterns into systematic edge? Next, we crack open the exact screening criteria that professional operators use to separate signal from noise, plus the environmental controls that make discipline automatic instead of aspirational. The Sniper protocol gave you the framework. Now, we load the ammunition. These 5 confluence filters transform pattern recognition from gambling into systematic edge, from hopeful guessing into professional risk management. Each filter operates as an independent gatekeeper. If any single factor fails, the trade dies regardless of how textbook perfect the pattern appears. This isn't flexibility. This is survival. Trend alignment demands your pattern swim with the current, not against it. Pull up daily and weekly charts before touching. The entry trigger? Is institutional money flowing with your directional bias or preparing to crush it? Bullish patterns forming within established downtrends are statistical suicide unless you're catching knife-edge reversals with overwhelming confluence. The trend represents the path of least resistance where big money moves. Fighting it means you're betting your retail account against institutional flow. Counter-trend patterns require triple confirmation, structure breakdown, volume exhaustion, and momentum divergence, all screaming reversal simultaneously. Otherwise, you're a salmon swimming upstream toward deeper pockets and longer time horizons. Structure positioning anchors your entry near meaningful levels where real money makes real decisions. Your pattern must form at significant support, resistance, previous day extremes, or institutional order zones. Mid-range entries are statistical traps. No meaningful buyers below you, no obvious sellers above you, just noise masquerading as signal. Professional operators wait for price to reach prior swing levels, gap fills, psychological round numbers, or algorithmic clustering zones where institutional orders accumulate. If you can't identify why smart money would care about your entry level, neither should you. Structure is where the real game happens. Patterns are just the visual packaging. Volume confirmation serves as the market's truth serum because price can lie, but participation reveals real intention. Genuine breakouts breathe with expanding volume on directional moves and contracting volume during pullbacks. Breakouts on declining volume are head fakes waiting to reverse. Pullbacks on expanding volume signal distribution, not healthy retracement. Volume should agree with your directional thesis. Buyers stepping in with size on dips, sellers exhausting themselves on rallies. When volume contradicts price action, trust the volume. It reveals who's actually participating versus who's just along for the ride. Risk-reward ratio operates as your mathematical survival filter. Minimum 1.2 risk-reward with surgical invalidation levels, though optimal setups offer 1.3 or better. Measure from entry to stop, then project that distance twice toward realistic targets. If the math doesn't work cleanly, the trade doesn't work at all. Hope is not a risk management strategy. Precise mathematics is. Your invalidation must be obvious. Below clear support, above defined resistance, outside the pattern's structural boundaries. Vague stops create vague results. Sharp risk management compounds into sharp profits over time. Market context provides the environmental overlay that can invalidate technically perfect setups. Consider sector rotation, earnings proximity, Federal Reserve meetings, and macro events that override technical analysis. Beautiful patterns mean nothing if earnings drop tomorrow or the sector is rotating out of favor. Check economic calendars, sector performance, and overall market regime. Are we in risk-on or risk-off conditions? Is your stock swimming against sector currents? Context kills more technically perfect trades than any other single factor, yet most traders ignore it completely. The 3-no rule rewires your dopamine system from chasing novelty to rewarding selectivity. You must consciously reject 3 patterns before considering the 4th. Count your passes. No. Fighting trend. No. Mid-range entry. No. Volume declining. This simple behavioral lock eliminates impulse trading and trains your eye for quality over quantity. Most days, even the 4th setup won't pass, and that's exactly the point. Patience compounds better than profits. Environmental design makes discipline automatic instead of aspirational. Hide P&L during execution, so gains don't seduce you and losses don't panic you into revenge trades. Use single ticker focus to eliminate FOMO from multiple charts. Implement wait timers. 5 minutes minimum between pattern recognition and order execution. This cooling period lets rational analysis override emotional impulses when your account is bleeding and patterns start looking obvious. Your operator card template consolidates everything. Sniper checklist, 5 confluence gates, risk per trade, and invalidation rules on one laminated reference. When pressure builds and shortcuts whisper seductively, your card anchors you to systematic thinking. These filters force you to think like institutional money instead of retail emotion. Professionals don't trade patterns. They trade probability, structure, and risk-adjusted returns while passing on hundreds of mediocre setups to capture the rare few offering genuine edge. But how do these filters perform when news whipsaws your setup or lunchtime chop turns perfect patterns into statistical noise? Next, we stress test this system through battle-tested scenarios where these filters either save accounts or create profits under real market pressure. The Confluence Code isn't theory waiting for practice. It's battle-tested armor that deflects market chaos while others bleed capital. 4 scenarios, same market conditions, 2 trader identities, mathematical proof that process beats pattern spotting when volatility strikes and emotions surge. Scenario 1. News, whipsaw. A textbook bull flag forms Tuesday afternoon, clean consolidation with rising support. Pattern chaser sees perfection and enters at the breakout, risking 2% because flags work 70% of the time. He missed the small e beside the ticker, earnings after close. The stock gaps down 6% overnight on guidance miss, obliterating his stop and account equity. Total damage, minus 2.4R, plus psychological trauma. Pattern operator sees identical structure, but runs market context filter first. Earnings tonight equals binary chaos regardless of pattern beauty. She passes, preserving capital for post-earnings clarity when fundamentals are known and volatility contracts. Her P&L reads flat. Her mind stays fresh for tomorrow's clean opportunities. Scenario 2. Lunchtime chop. Between 11:30 and 1:30, momentum dies into sideways noise. Pattern chaser sees microflags everywhere, scalping tiny breakouts that reverse within minutes. 6 trades, 3 winners at 0.2R each, 3 losers at 0.4R each, net minus 0.6R plus. Commission bleed and emotional exhaustion. Pattern operator recognizes range-bound conditions and implements chop filters. No pattern smaller than daily structure, no breakouts during institutional lunch break. She takes 0 trades, journals 2 clean passes, and positions for the 2 p.m. re-engagement when real money returns. Boring beats busy when market character favors patience over participation. Scenario 3. False breakout trap. An ascending triangle approaches yesterday's high. Daily resistance where professional sellers wait with size. Pattern chaser buys the breakout because price is king, ignoring structure overhead. The stock pokes through by 15 cents, attracts momentum chasers, then snaps back hard as sellers unload into the buying frenzy. He holds hoping for rescue, then stops out at minus 1.3R when support fails. Pattern operator notices the same breakout, but applies structure positioning filter. Entry level sits directly into daily resistance with no meaningful buyers above. Classic trap setup. She waits for the failure, then shorts the trapped longs with tight risk above the false break. Target, triangle support. She captures plus 1.9R from the exact pattern that destroyed the chaser. Scenario 4. FOMO squeeze. A momentum stock rockets 4% in 20 minutes on sector rotation news. Pattern chaser sees the move, assumes continuation, and sizes up to 3% of his account to catch the wave. No structure analysis, no invalidation level. Pure momentum chasing at maximum extension. The stock immediately reverses into the close as profit-taking overwhelms late buyers. He stops out at minus 2.2R. confidence shattered. Pattern operator sees the same squeeze, but applies risk-reward filter. Entry here offers poor mathematics into no meaningful structure above. She either takes a surgical probe with 0.3R risk at a prior pullback level or stands aside completely. Strategic inaction preserves capital for setups offering genuine edge. Mathematical reality separates survival from destruction. Pattern Chaser's Day, minus 2.4R, minus 0.6R, minus 1.3R, minus 2.2R equals minus 6.5R plus emotional debt that compounds into revenge trading. Pattern Operator's Day, flat, plus 1.9R, flat equals plus 1.9R with 0 psychological damage. Same pattern recognition ability, opposite financial and emotional outcomes. The small account objection reveals flawed thinking. I need bigger risks to grow faster? Wrong. Discipline scales up exponentially. Undisciplined risk scales to ruin linearly. A disciplined trader with 5,000 becomes disciplined with 50,000. An undisciplined trader blows accounts regardless of size because the problem isn't capital, it's process. Small accounts benefit most from selectivity because every loss hurts more, forcing better decision-making habits early. Professional trading is systematically boring by design. You say no to 90% of patterns to profit from the perfect 10%, offering genuine confluence. Entertainment and profit are inversely correlated. The more fun your trading feels, the more money you're probably losing. Operators understand that excitement signals emotional involvement. Detachment signals professional execution. Environmental controls make this discipline automatic. Hide P&L during execution. Use single ticker focus. Implement wait timers after stops. Speak if. Then rules aloud to anchor systematic thinking. The market teaches through feedback, not judgment. But knowing the system isn't becoming the system. How do you permanently rewire the dopamine loop that craves action over accuracy? How do you build rituals that make patience automatic and transform systematic thinking into unconscious habit? Next, we engineer the complete identity upgrade from pattern junkie to market professional. Habits beat hope, systems beat moods. Sustainable transformation doesn't come from trying harder when pressure builds. It comes from replacing the rituals that feed your dopamine addiction with rituals that feed your discipline. Your identity upgrades every time your behavior reflects systematic thinking over emotional impulses. The market is a mirror. It reflects your internal order or your internal chaos. If you arrive scattered, charts look noisy. If you arrive structured, the same price action becomes readable. We engineer 3 rituals that transform patience into muscle memory and rewire you from pattern-chasing gambler into professional operator. Pre-market ritual establishes context before emotions engage. Start with higher time frames, weekly, daily, mapping trend direction, key supply and demand zones, and previous session extremes. Identify 3 A+ setups maximum where all confluence factors align: trend, structure, volume, risk-reward, and context. Write them down with precise entry, stop, and target levels. Then define do-nothing conditions in advance: earnings, proximity, lunchtime chop, mid-range price action, or personal emotional stress. This pre-commitment removes the wiggle room where gamblers rationalize marginal trades. 5 minutes of honest context mapping saves 5 hours of emotional cleanup later. Execution ritual operates on one non-negotiable rule: plan first, click second. No entry without complete sniper analysis and 3-point confluence confirmation. Speak your checklist aloud to engage analytical processing. Setup structure defined, narrative aligned with trend, invalidation level at 46.15, position size 1.5%, if then, triggers ready. Verbal processing creates cooling time between recognition and action, letting the operator drive, while the gambler sits quietly. Remove emotional fuel by hiding P&L during execution and using single ticker focus to eliminate FOMO. Install wait timers. No trade within 5 minutes of pattern recognition, 90 seconds after news, 90 seconds after any stop out. This friction prevents impulse from hijacking systematic thinking. Post-market ritual converts daily experience into systematic improvement. Screenshot every entry and exit with context visible. Log emotional state during each decision: calm, urgent, hopeful, vengeful. Rate pattern quality from 1 to 5 based on confluence factors present. Review if then rule performance and refine based on market feedback. Ask 3 diagnostic questions. Did I follow Sniper completely? What did the market try to teach me? Which rule needs tightening for tomorrow? This isn't punishment. It's data collection for continuous edge refinement. Reframe your dopamine addiction from action seeking to quality seeking. Action isn't progress. Clean passes are profitable decisions. Every marginal pattern you reject preserves capital for the exceptional setup that follows. Train your reward system to celebrate patience as much as profits. Create a pass streak scoreboard and mark sequences of disciplined rejections as wins. Your brain learns what you reward consistently. Anchor patience with the sniper metaphor. 1 clean shot with perfect setup beats 10 noisy attempts. Snipers don't fire because targets appear. They fire when wind, distance, and timing align perfectly. Your job isn't hunting patterns, it's waiting for confluence. Professional operators understand most days offer 0 A+ setups, and that's exactly why they compound capital, while pattern chasers blow accounts. Implement detachment practices that separate emotion from execution. After any stop out, enforce a 90-second reset. Close the platform, take 3 deep breaths, review your operator card, and ask whether your next decision comes from systematic analysis or emotional reaction. This cooling period prevents tilt from cascading into account destruction. Add a pre-trade body cue, relax shoulders, unclench jaw, to disrupt urgency before it builds. Run a pre-mortem exercise each morning. If I blow up today, what would I have done? Write the list. Sized up after losses, moved stops to avoid small scratches, chased mid-range breakouts, ignored earnings calendars. Then design systematic blockers, fixed risk per trade, hard stop automation, calendar alerts, and no trade zones around mid-range price action. Fear shrinks when you name the traps and lock the doors proactively. Connect this transformation to compounding mathematics. Consistency beats excitement because steady gains compound exponentially, while volatile swings compound toward 0. Boring profits beat exciting stories because sustainable edge comes from process repetition, not lucky guesses. Identity follows behavior. Each ritual completion is a vote for operator over gambler. But knowing the system isn't becoming the system. Next, we synthesize every piece: sniper steps, confluence filters, mirror checks, and environmental controls into your complete personal pattern protocol with a full trade walkthrough that demonstrates professional execution from watchlist to review. Time to fuse every component into one unbreakable machine. Your personal pattern protocol synthesizes sniper steps, confluence filters, mirror checks, and environmental design into systematic execution that makes disciplined trading automatic instead of aspirational. No more hoping, no more gambling on pictures, no more emotional position sizing that destroys accounts through variance clustering. Context over patterns, confluence over conviction, process over profits, survival over glory. Your integrated protocol flows like clockwork. Pre-market ritual establishes higher timeframe context and identifies maximum 3 A+ setups where all factors align. Pattern recognition triggers immediate mirror check. Am I reading this pattern or creating it from hope or fear? Sniper analysis begins only after confirming emotional neutrality. 5. Confluence filters gate every potential entry. trend alignment, structure positioning, volume confirmation, risk-reward ratio, and market context. 3 independent confirmations required. 2 isn't enough. 1 is gambling. Execution follows if, then rules with predefined risk, 0 mid-flight changes, and systematic profit-taking at structural levels. Post-trade review logs every decision and emotional state for continuous refinement. Watch professional execution unfold in real time. Your pre-market ritual reveals weekly uptrend on AAPL, approaching a demand zone between $175.80 and $176.20. Institutional buying interest, likely based on prior breakout volume. Current daily structure shows higher lows intact, with yesterday's low at 176.35. You mark supply resistance near 178.10, where sellers previously appeared. 3 hypotheses written with precise entries, stops, and targets. Do nothing conditions defined. No trades into earnings next week. No breakouts during lunchtime chop. Stand down after 2 consecutive scratches. The open brings noise. 2 patterns appear quickly. First is a mid-range wedge with declining volume. Mirror check reveals you're creating hope from chaos. Pass 1 logged. 10 minutes later, a micro breakout forms directly under 178.10 resistance. Structure positioning filter fails immediately. Pass 2 logged. Your dopamine protests. Your protocol celebrates. Capital preserved, attention sharp, discipline muscle strengthening. Now the market delivers the look. Price pulls into the 176.20, 175.80 demand zone on declining volume, holds cleanly above yesterday's low, then forms a textbook 5-bar flag on declining volume. Sniper protocol activates. Setup identification, bull flag with clear base at 176.122, resistance at 176.70, ascending support line connecting 3 touches. Narrative, analysis, higher time frame trend up, buyers defending institutional demand zone, sector rotation, favoring technology. Invalidation level, 176.15, below both demand zone and flag structure. Position sizing, 1% risk equals $500 on your $50,000 account, translating to roughly 125 shares with 40-cent risk per share. Execution rules locked. If reclaim of 176.50 with expanding volume, then enter. If first target at 177 hits, take partial. If stop triggers, exit completely with no questions. Volume expands, price reclaims 176.50 with authority. Entry triggered at 176.52. No second guessing, no mid-flight edits, just systematic execution. At 157.30, you take first partial for 0.78R realized. Price pushes toward 177.95, stalling under the 178.10 supply zone you identified pre-market. Second partial taken, locking 1.4R total. A pullback tests 177.20. Your stop remains at break-even per rules after first partial. No cowboy adjustments. Final push reaches 178.05, just kissing supply resistance. You exit remainder at 177.98 for total trade result, 1.9R, with 0 emotional residue. Boring, clean, professional. Contrast the alternate universe where pattern addiction destroys discipline. Same setup triggers dopamine surge without systematic analysis. Pattern chaser enters on second green candle without volume confirmation or precise risk calculation, sizing 3% because this looks perfect. Stop placed somewhere below the flag without surgical invalidation. When price hesitates at first resistance, hope replaces planning. Stop moved lower to give it room. Second push fails. Panic selling into support break for minus 2.2R. Emotional damage compounds into revenge trading as he chases the next shiny pattern to make it back fast. This demonstrates compounding expectancy, not just capital. Each disciplined pass raises the average quality of your remaining trades, lifting win rate and average R multiple while compressing losses. 10 trades at 0.2R average yield 2R total. 5 trades at 0.4R average yield same 2R with half the psychological wear. Selectivity compounds because variance shrinks, and your best analytical work gets more of your risk budget. Strategic inaction becomes your secret weapon. Doing nothing preserves capital and attention for genuine edge when confluence aligns perfectly. The operator's mantra lives on your monitor. Context over patterns, confluence over conviction, process over profits, survival over glory. Context reveals market intentions behind pattern formations. Confluence provides independent confirmation over gut feelings and hope-based projections. Process compounds into sustainable edge, while profit-seeking creates emotional interference that destroys systematic thinking. Survival keeps you available for the next high-probability setup. When others blow accounts, chasing excitement and entertainment, your job isn't being right. It's staying solvent and available. Professional operators understand markets move in cycles of clarity and confusion. During confusion, preservation beats participation. During clarity, systematic execution beats emotional reaction. The mathematical reality is unforgiving. Consistent, small edges compound exponentially over time, while inconsistent, large swings compound toward zero through variance clustering and emotional spirals. Lock in environmental design so discipline becomes automatic instead of aspirational. Hide P&L during execution to prevent gains from creating overconfidence and losses from triggering panic. Use single ticker focus to eliminate FOMO from multiple charts screaming for attention. Enforce 5-minute wait timers after pattern recognition and 90-second resets after any stop out. Speak your checklist aloud to engage analytical processing. Pattern defined, context aligned, invalidation set, size fixed, if, then rules locked. Physical operator. Cards provide quick pattern evaluation when pressure builds and shortcuts whisper seductively. You've transformed from pattern-chasing gambler into systematic risk manager. Every tool integrated, every filter calibrated, every behavioral lock installed. Your personal pattern protocol eliminates emotional interference and creates repeatable edge through disciplined execution. The mirror reflects order instead of chaos. The sniper waits for perfect shots instead of spraying bullets at moving targets. But systems require accountability to become permanent habits. Individual discipline is powerful. Community accountability is bulletproof. Next, we establish the 30-day transformation challenge with public commitment, shared language, and systematic reinforcement that makes this identity shift irreversible. Ready to lock in your operator identity forever? The transformation ends where it began. With a choice that defines your trading future, the binary couldn't be starker. Remain a pattern-chasing gambler trapped in emotional cycles that bleed accounts and shatter confidence, or evolve into a disciplined market operator, building sustainable edge through systematic execution. Every click from here forward casts a vote for your identity. The market doesn't care about your intentions. It only responds to your actions. One identity needs action. The other needs alignment. One worships pictures. The other manages risk. You've seen the contrast, the stories, the math. The market won't negotiate with feelings, but it will reward rules. If you want different results, you must become a different trader by design, not by mood. That means replacing impulse with protocol and excitement with process. The transformation becomes real only when it's public and measurable. Private promises fold under pressure. Shared commitments harden into identity. Your 30-day transformation challenge begins now, structured to rewire your dopamine system from action-seeking to quality-seeking while building systematic execution into muscle memory. Week 1 is construction, not performance. Build your personal pattern protocol from the ground up, integrating sniper steps with confluence filters and environmental controls that make discipline automatic. Write your systematic approach in your own words so it's usable under stress. Define your 5 confluence filters with explicit pass-fail language. Trend aligned or reversal with triple evidence, structure at meaningful levels, volume agreement, minimum 1.2 risk reward, market context cleared for news and sector flow. Create your laminated operator card listing risk per trade, invalidation rules, if then triggers, and pre-market context checklist. Design environmental controls that prevent emotional hijacking. Hide P&L during execution, single ticker focus, 5-minute wait timers after pattern recognition, 90-second resets after any stop out. Curate a tight watch list of no more than 8 names with clear higher timeframe narratives. Finally, write your do-nothing conditions in plain English, so there's zero wiggle room. When urge, boredom, or fear tries to hijack systematic thinking, weeks 2 through 4 implement total systematic immersion with strict constraints. Execute only trades that pass all 5 confluence filters while logging every decision and emotional state. Cap daily attempts at 3. After 2 consecutive losses, stand down 30 minutes minimum. No exceptions. No, just this once compromises. No emotional override codes when your account bleeds and shortcuts whisper seductively. Every pattern recognition triggers mirror check first. Am I reading this pattern or creating it? Followed by complete sniper analysis, then confluence confirmation. 3 independent factors must align or you pass, preserving capital for genuine edge when market conditions favor systematic execution over emotional reaction. Speak your plan aloud before clicking. Honor invalidation without negotiation, and log each step with screenshots, context notes, R multiple outcome, and emotional tags at entry, management, and exit. Daily accountability transforms private discipline into public commitment while building community reinforcement. Post 1 annotated chart analysis each trading day, showing higher timeframe context assessment, confluence evaluation, naming specific pass-fail criteria, and honest emotional state check scored from 1 to 5. Screenshot your passes as victories. Every marginal pattern rejected is capital preserved for exceptional opportunities when proper confluence aligns. Start each post with operator mindset activated to make a public promise that drowns out impulse and connects you with others implementing the same systematic transformation. Give rule-based feedback to 2 peers because iron sharpens iron, and pair with an accountability partner who checks in after any stop-out to enforce your 90-second reset protocol. Track 3 metrics on your wall that measure process over profit. Percentage of trades meeting all filters, average R multiple per trade, and consecutive pass streak length. If any metric slips, tighten a rule the next morning. The goal is fewer, cleaner trades with rising average returns and shrinking variance through systematic selectivity. Nightly, grade pattern quality and process adherence, not just P&L, asking 3 diagnostic questions. Did I follow Sniper completely? What did the market try to teach me? Which rule needs refinement for tomorrow? Future content addresses your evolving needs as systematic execution becomes second nature. Small account protocols show how fixed risk and ruthless selectivity protect limited capital better than desperate position sizing. Part-time trading systems work around full schedules without sacrificing analytical edge through tight watch lists and alert-based monitoring. Advanced confluence techniques refine pattern filtering as your experience deepens, including relative strength analysis, failure pattern setups, and institutional flow recognition that elevates your systematic approach beyond basic technical analysis. Remember the stakes that brought you here. Without systematic filters, market variance becomes psychological trauma that compounds through revenge trading, emotion-based position sizing, and hope-driven risk management that destroys accounts faster than ignorance ever could. With proper protocols, the same variance becomes manageable and profitable through controlled losses, systematic position sizing, and rule-based execution that creates sustainable edge over time. The mathematics are unforgiving, but fair. Consistent, small edges compound exponentially through disciplined execution, while inconsistent large swings compound toward zero through emotional decision-making and variance clustering. We've delivered every promise from our opening paradox. You've learned to flip the core belief from patterns predict price movement to patterns describe market structure requiring context and confluence. You understand the neuroscience of pattern addiction, how dopamine pathways treat pattern recognition like gambling, creating intermittent reinforcement that hijacks decision-making through pareidolia and confirmation bias. You've implemented the sniper protocol that transforms subjective pattern spotting into objective market analysis through setup identification, narrative analysis, invalidation levels, position sizing, execution rules, and systematic review. You've mastered confluence filters that separate signal from noise through trend alignment, structure positioning, volume confirmation, risk-reward mathematics, and market context assessment. You've practiced strategic inaction as your secret weapon, understanding that preservation during confusion beats participation, while systematic execution during clarity beats emotional reaction. You've engineered complete identity transformation from reactive pattern chaser to proactive risk manager through ritual replacement, environmental design, and systematic reinforcement that makes patience profitable and discipline automatic. The mirror metaphor anchors self-awareness. The market reflects your internal order or chaos. The sniper metaphor anchors patience. One clean shot with perfect setup beats 10 noisy attempts at moving targets. Your final mantra lives where you can't miss it. Mirror before monitor, confluence before conviction, process before profit, operator over gambler. Mirror reflects your internal state before external analysis begins, ensuring emotional neutrality drives systematic thinking. Confluence provides independent confirmation over gut feelings and hope-based projections that create false confidence in marginal setups. Process compounds into sustainable edge, while profit-seeking creates emotional interference that destroys systematic execution. Operator identity builds methodical execution, while gambler identity destroys accounts through variance clustering and emotional spirals. Subscribe to join the 30-day challenge and access your complete operator transformation toolkit, customizable protocol templates, laminated card designs, tracking spreadsheets, and community accountability systems that make this identity shift permanent. In your first comment, share your completed operator card and tell us which pattern you're retiring until proper confluence aligns. This public commitment activates social accountability that transforms intention into identity. Connect with other operators implementing the same systematic approach, celebrating passes as victories and patience as profit. The ultimate question remains crystal clear. Will you choose the casino or the protocol? The pattern-chasing gambler's path leads to blown accounts, shattered confidence, and endless cycles of hope, followed by devastating reality. The systematic operator's path leads to controlled risk, sustainable edge, and compounding capital through disciplined execution that treats variance as manageable business expense rather than personal trauma. Your identity follows your behavior. Your behavior follows your choice. Your choice starts now.